Hi, I'm Steve Van Metre. Welcome to your Monday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of some markets. Yeah, they're just still not making a whole lot of sense right now, but that's all right. Tonight's topics are, is the dollar, or is the conclusion of the Mexico immigration issue dollar bullish or dollar bearish? Regardless of your answer, you're going to be wrong. You know, you're going to love this. Then we're going to take a look at how the hedge fund managers, or as we affectionately refer to them, the dumb money is positioned, and look at the NASDAQ summation index, because it's telling us something that we should be concerned about. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, my own personal capacity. The opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. All right, first question. Is the Mexico immigration deal dollar bullish or bearish? And the answer is neither. Look, nothing. Okay, let's establish one very clear fact. Nothing changed. We did not implement tariffs. We did not remove tariffs. Nothing changed. This should be market neutral. It should not be market euphoria. It should not be bond euphoria. It should be like, well, hey, everything's the same as it was yesterday. But investors don't look at it that way. For some reason, now all of a sudden they think, well, there is no tariff being added to Mexico, so it has to be really good for stocks. It's neither good nor bad. It's neutral. Now I want you to understand. I'm gonna load up this chart of the dollar. This is a dollar index, and on Friday here, see this tan line? This is the 200-day moving average, or the average closing price over the last 200 days. Now we'll zoom in here so you can see Friday. It bounced right off its 200-day moving average and then close slightly higher. Now the question that I have for you is it bullish or bearish? And the answer is the smart money set the market up. I want you to see what the smart money did. They drove the dollar down right to this 200-day moving average. Now why would you do that? Well, it's pretty simple. When a security comes down to its 200-day moving average and bounces, well, off. I always been backwards here. When it bounces off the 200-day moving average, it's considered bullish. When a security falls below its 200-day moving average, it's considered bearish. So the question is, why did the dollar get driven down to its 200-day moving average on the night before the trading day before the tariffs would have been implemented today, had they been? It's simple. It's to fool as many people as possible. Because at the moment right now, you have to look at the chart and say, well, what happened Monday? It went higher. No surprise. It went up, meaning the interpretation the market will take from this is that no new tariffs to Mexico is dollar bullish. Now, why does that matter? Because the smart money's been selling the dollar for the last several years. Don't believe me? Let's still look at that. We've looked at it, but let's look at it again. The smart money has been selling the dollar since January of 2015. They've been dumping them. Now, if you're selling something and you've got more to sell in your inventory, what do? Well, you give people reason to buy. And how do you do that? You drive something down to its 200-day moving average right before something good or bad could happen. And then regardless of the outcome, now I know this is saying, regardless of the outcome, you come in and you buy the dollar the Monday morning if you're the smart money. And why do you do it? In fact, you did it in overnight trading. Why do you do it? To create a bounce off the 200-day moving average. So the traders who trade around moving average will see the price is falling and hitting support of the 200-day moving average, and then they'll bring buyers in, and then you sell. Seems far-fetched? Well, it's not, because when securities bounce off their 200-day moving average, they rally. And there you go. So I thought that was really interesting where the dollar landed, because it set up a no-lose situation for the smart money. No matter what the outcome is, even if there were tariffs put on, all they had to do was pump the dollar, and the financial media would interpret it either outcome as dollar bullish. There you go. That is how the smart money works, and kind of interesting to see it firsthand. All right, so let's take a look at NASDAQ McClellan Summation Index. Now this thing has broken zero. It's down as of Friday because it's always one day behind, minus 329. And there's only a couple of the people that I know that actually follow this, and it is pretty cool because it does give you an idea of what's going to happen. Their comments today were, uh-oh, it didn't bounce off of the short-term rally. And the last time it didn't bounce, when the market did, was back in October 16, and this predicted a much bigger sell-off. Well, guess what? It didn't bounce. So now this tells us that perhaps we are looking at a much bigger market correction coming than anyone thinks is going to happen. And if let's see, yeah, let's go take a look real quick at where, there it is, the S&P 500. We'll go back to zoom in. Here's October. The McClellan Summation Index on the NASDAQ, I mean, it's the same here. NASDAQ went down, then it signaled it was going down, but the NASDAQ bounced, should have triggered a bounce, and the Summation Index didn't. The NASDAQ went down again, tried to bounce again, and then boom, fell because the Summation Index was saying there's something wrong in the plumbing, and you don't know what it is, and you can't see it, but it's not good. So we're seeing that same setup once more. All right, let's take a look at how the hedge fund manager's position, and then we'll go dig through the charts. Actually, we're going to do it simultaneously for fun. All right, on to 10-year Treasury yields. So this is our yields. Remember, the green is the dumb money or the hedge fund managers. If there was an opposite direction, if the gentleman who makes these charts actually colored in the opposite position, the smart money takes an equal and opposite position at whatever the dumb money is, they're up here. So if there was yellow lines, they would be opposite up here, showing the smart money positioning. So the dumb money is shorting bonds. Now, at the moment, you could read this and say, well, they look like they're in the correct direction. No, they're running the opposite direction. So the dumb money thinks that the red line should be going higher, not lower. And you can see that they've been betting, the dumb money has been betting that yields are going to rise, and they've been taking an increasingly larger short positions, and they're not rising. Now let's look at the charts because this is really worth taking a look at. Now 10-year Treasury yields came down, and we're going to have to make a new line. I don't really need one, but just so you can see it, we'll put it down here, and we'll put that, make it dotted, and we'll zoom out. Now, traders have been looking at this as the final line of support, and it came down here. The other argument they're saying is this is a 61.5 retracement, Fibonacci retracement from the top, and usually when things drop 61.5% from their top, that's the bottom. So what the hedge fund managers are doing, the dumb money, is they're coming in and shorting the Treasury bond market because they think this is the end. They think this is the end of the move, and that yields are going to go boom, straight higher. And why would they think that? Well, they're going to think that for one very, very clear reason, and the answer is the stock market's up here. So we do know that as the stock market rises in our monetary system, yields need to rise. So if yields are falling and stocks are rising, that tells us somebody's wrong. The only question is who and when is wrong. Well, we know the stock market's wrong because crude oil is down, interest rates are down, other commodities are down, global economy is down. The only thing that is up is U.S. stocks. And we know they are on the wrong side of this fence. But in order to fix this positioning, so if you were a hedge fund manager and you saw this and you go, hey, this is a problem, how do you fix it? You simply drive yields higher. That's your solution. You just short the bond market. If you can bring yields up, it validates your stock position and you're fine. If you can't bring it up, it tells you you're in danger for a big decline in the market. And what does that NASDAQ Summation Index tell us? That yes, this is indeed the correct move and the stocks do need to follow. That is what it's telling us. So yields are bouncing off of this support here, but they're not finding a lot of traction here. And should they fail to hold in this area, and you can see they're just kind of trading right, and if we can make this in a little band, they're trading right in between here. So they're finding, this is support, up here is resistance. We'll zoom in, and you can see they're playing right here with the, this part right here is where they're trying to find resistance. We could even maybe nudge this line up a little bit more. but it's really close, and you can see yields are right there. So if these short sellers, if these hedge fund managers can get enough money behind this, they can push yields back up to 2.3. That would help their market case. If they can't, then stocks are going to come back down at some point to fix that problem. But that's why they're the dumb money, because they don't understand that banks are buying bonds, and now the Fed is actually going to cause long-term interest rates to fall. And you'll read more about that in this Friday's update. So looking at the long bond 30-year Treasury, now this is very interesting. Again, the dumb money thinks 10-year Treasury yields are going up, but 30-year yields aren't. It doesn't make it makes no sense. And my guess is when we see this report next week, for this week, that this is even going to be deeper. They're really going all in here, and they're fighting the trend in the wrong direction. Looking at oil, crude oil, West Texas Intermediate, we've seen as crude oil prices are falling, these hedge fund managers are backing off their long positions, but they're still very, very long this market. And they don't understand at the moment that monetary decelerations lead to lower asset prices, including crude oil. And if we go and take a quick look, let's see what the crude oil chart is telling us today. Here we go. I think kind of more fun to kind of look at one and then go look at the charts. We'll see. You can see that crude oil, this is a supply zone between buyers and sellers. And you can see it came down into the supply zone, bounced up. I said, don't buy into this. This is not the bottom. And sure enough, today it tried to cross over. It tried to break out of resistance, got rejected back down. And I'm going to go on a limb and predict that there's going to be a crude oil inventory build showing in the API and the EIA reports coming out tomorrow and Wednesday. So this tells us that crude oil is headed lower, and it also tells us that these people are completely wrong in their positioning. Looking at the S&P 500, the hedge fund managers are taking long positions now as the as the smart money is now shorting the market. So they're luring people back in. It's very important to understand they're luring people back in the market because they understand that monetary decelerations do lead to lower stock prices. We're not going to look at Euro futures, gold futures. Now, isn't this is a really another good lesson. So the hedge fund managers took a long position on gold because they actually thought the Mexico deal was going to lead to tariffs and tariffs and tariffs. Whoops, they were wrong. Now I did too. I thought, but hey, apparently President Trump got what he was looking for. And as far as I'm sorry, let me switch over here. As far as gold goes, remember I said it's going to come up and hit this resistance level. Well, who drove it up here? The hedge fund managers. Who's going to sell here? The smart money. Why is the smart money selling here? Because they want to buy down here. They want to buy at a lower price level, and they need to get everybody in. And the more times people come in and get rejected at a certain point, they will eventually sell. They will tuck tail and run, and that means all gold prices have to do is fall below, say, roughly 1270, and you'll see them drip all the way back down, potentially into the low 1200s. It's all you have to see here, and that is certainly courtesy of the smart money luring people in at the opportune time. We'll make sure we're on the right page. We are. Looking at NASDAQ, the hedge fund managers are slightly long, nothing to get excited about. Looking at small caps, the hedge fund managers are short, and guess what? Small caps are rising. I mean, these people are just consistently on the wrong side of this market right in here. And looking at the US dollar, why would the smart money drop this thing down, drop the dollar index down to its 200-day moving average and then drive it up the next day? Simple. They know hedge fund managers are long. It's everywhere I turn. Everyone's dollar, 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 dollar. I've made multiple cases. Even though I do believe in the short term the dollar could rise, long term is headed lower. And I'm even putting in a deeper case to that too for the following Friday, actually, not this Friday, the next one. So, hey, if you know everybody is long the dollar because they believe the dollar is going to rise, you give them every incentive to buy, and that's bouncing off the 200-day moving average. And volatility futures are roughly flat, and not much of a change here. Smart money is very long volatility. Dumb money is short. I suspect that we will see an increase in the short volatility position next week. I'll probably be wrong, but that will be my prediction at the moment. All right, well, that's our update for the week, and on not the week, for tonight. On Wednesday, we're gonna, as long as I remember correctly, I'm gonna show you some cool stuff. We're gonna look at the Wyckoff accumulation pattern, but we're gonna look at it with gold. I'm looking at this weekend. You're gonna like it. All right, I'm Steve Van Metre. Bye now.